Hi everyone, welcome back to Corporate Decoder, the place where we untangle the wild world of corporate filings. Today we're diving into a Form 8K, which is basically a corporate oops. We did something important here, involves some money shuffling that might raise a few eyebrows. So what's the quick version? Yale Transaction Finders Inc. just took on some debt by issuing notes to some closely related parties, and the way this debt can convert into stock is interesting. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss about these filings with other people. Alright, let's get into this Form 8K. First off, this is a current report, meaning it's about something that just happened. The date of the event, May 2, 2025. This document tells us about recent and significant happenings. The company in question is Yale Transaction Finders Inc. based in New York. It's incorporated in Delaware and the file number is 000052528. They're considered an emerging growth company. This means they're a smaller company still growing. They are not electing to use the extended transition period for complying with new or revised financial accounting standards. Now for the good stuff, item 203, which is all about creating a direct financial obligation or debt. On May 2, 2025, Yale Transaction Finders issued convertible promissory notes. Think of these as loan agreements that can turn into company stock under certain conditions. These May 2025 notes totaled $17,500, so this is not a large amount. These notes were issued to three groups: Ironbound Partners Fund LLC, which is connected to the Chief Executive Officer, Moyo Partners LLC, linked to the President and Treasurer, and Dakota Group LLC. These are called affiliates because they are closely related to the company's leaders. The notes mature or come due on December 31, 2025. The interest rate is 5.0% per year, payable when the notes mature. Here's where it gets interesting. The holders of these notes can convert the principal, that is the amount of the notes, and any accrued interest into shares of the company's common stock. This can happen after what they call a qualified financing or a fundamental transaction. A qualified financing is when the company raises a certain amount of money, and a fundamental transaction. A qualified financing is when the company raises a certain amount of money, and a fundamental transaction is like a merger or what they call a qualified financing or a fundamental transaction. A qualified financing is when the company raises a certain amount of money, and a fundamental transaction is like a merger or a big change in the company's structure. The price at which the notes convert into stock is the conversion price. The company says they're using this money or will use it to fund their working capital needs. Working capital is basically the money a company needs to run its day-to-day operations. If you want to read all the fine print, the actual form of the promissory note is filed as Exhibit 4.1. Item 9.01 lists the exhibits attached to the report. Exhibit 4.1 again is the form of the promissory note, and Exhibit 104 is something called the cover page interactive data file, which is part of how they file their documents electronically. Now let's step back and think about what this all means. A company issuing convertible notes to insiders isn't automatically bad, but it definitely warrants a closer look. Here's what stands out. Because it's a small amount of money, $17,500 isn't a make or break figure for most companies. The notes are going to insiders, loans to executives, or affiliated entities always raise questions about fairness and whether the terms are as good as what an outside lender would offer. The conversion feature is key. The note holders can convert their debt into equity. This can be good for the company if it means they don't have to pay back the debt in cash, but it also dilutes the ownership of existing shareholders. Working capital, they say the money is for working capital, which means that they are short on cash. This is a company that may be struggling to stay afloat. So what do we have here? We have an emerging growth company that isn't doing very well and is taking a small amount of money from internal parties to fund their operations with an interesting clause that the debt can be converted into equity later. Alright, that's our breakdown of Yale Transaction Finders' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.